The Bank of Canada just sent a message that most Canadians were not expecting. And honestly, it changes everything about where rates are going for the rest of 2025 and 2026. For months, people have been asking the same question: when are rates finally going to come down? Homeowners renewing in the next 12 months are hoping for relief. Buyers are waiting for lower payments, and a lot of experts have been predicting multiple rate cuts this year. But here's the truth: we're probably not going to see any more rate cuts in 2025, and the signs are already here. And some of the biggest signs is Canada's GDP actually grew, and the job data is coming in stronger than most are predicting. This surprised a lot of economists. We were expecting the GDP to be flat, possibly even slipping into mild recession, but instead, GDP came in stronger than expected. And while that might not sound like good news, and in many ways it is, it also makes it much harder for the Bank of Canada to justify cutting rates further. Think about it. If the economy is growing, if spending isn't collapsing, if jobs while weakening are still holding up, then the Bank of Canada can't turn around and say, yes, we need to stimulate even more. Rate cuts are a tool for weakness, not for growth. The GDP growth is not the only thing standing in the way. Yes, inflation has come down, but not enough. Yes, unemployment has ticked up, but not enough as well. And yes, interest rate pressure is hitting households, but again, not enough to justify another round of cuts without risking the exact same thing that the bank fears most: inflation bouncing back. And at the center of all of this is housing. Shelter inflation remains stubbornly high. Rent pressure are still intense. And because housing makes up almost roughly a third of the entire inflation calculation, the bank knows that even a small cut could reheat demand overnight. In another reality, Canada has one of the highest household debt levels in the world. That means rate cuts don't just help Canadians, they stimulate borrowing extremely quickly and too quickly. And one more layer: a growing economy plus high debt plus sticky shelter inflation plus a weak Canadian dollar. That's the exact recipe that forces the Bank of Canada to stay cautious. So when people say more rate cuts are coming, you have to ask, based on what? Because the bank is looking at a completely different set of risks than the average Canadian sees on the surface. If they cut too quickly, inflation roars back. If they cut too slow, the economy cools further. If they cut when GDP is growing, they lose credibility. And that's exactly why in this video, we're going to break down the real reasons why rate cuts may be done and what it means for your renewal, your buying power, and the future of the Canadian housing market. All right, now that we've set the stage, let's get into the real guts of this. These are the 5 forces that are quietly but powerfully pushing the Bank of Canada into a no more rate cut stance for 2025. Let's start with the biggest one: housing inflation, because this is the anchor that everything else is tied to. Here's the truth that most Canadians don't know. Even though overall inflation has cooled, shelter inflation still remains running way above target. Rent is still climbing. Mortgage interest costs are high, and the affordability crisis has not cooled off even after the rate hikes. Shelter makes up almost 1/3 of the entire inflation basket in Canada. 1/3. That means if just the shelter category stays hot, even if groceries, gas, and everything else cools, the bank cannot hit its 2% target. And this is where rate cuts become a problem. Cut the rates equals lower borrowing costs equals increased home buyer demand and pushes prices back up. Shelter inflation is on the rise again. So the bank is trapped. If they cut too fast, they risk undoing all of the progress that they've made. They simply can't afford another round of skyrocketing home prices. And this is why, whether people realize it or not, housing inflation is doing more to hold rates in place than anything else in the economy. Next, we have household debt situation, and this one is massive. Canada is one of the highest household debt to income ratios in the entire developed world. We're not talking slightly higher, we're talking top of the list. What does that mean? It means Canadian families feel rate changes way more than Americans, Europeans, and even Australians. In Canada, most mortgages renew in 1 to 5 years. In the US, people locked into fixed rates for 30 years. So when the bank tweaks rates even a little, Canadians react immediately. And here's the part the Bank of Canada is quietly terrified of. If they cut rates too much, too fast, Canadians will jump right back into massive borrowing. That means more heat in the housing market, more HELOC activity, more variable rate borrowing, more leverage, and ultimately more fragile in the entire system. High debt plus low rates equals the same cycle that created the last housing boom. The bank simply cannot trigger that again. Force number 3 is the Canadian dollar, and this is one that almost nobody talks about. Here's the simple version. If Canada cuts rates more than the US, the Canadian dollar drops. And when the Canadian dollar drops, everything we import gets more expensive. Fuel, food, building materials, electronics, you name it. A weaker dollar equals higher inflation. Higher inflation equals no more cuts. Right now, the gap between the Bank of Canada and the US Federal Reserve is already near the limits of what the markets tolerate. If the Bank of Canada cuts again while the US stands still, we risk a slide that becomes inflationary instantly. Most Canadians don't realize this, but the bond market controls fixed rate mortgages, not the Bank of Canada. And here's what's interesting. Bond traders are not pricing in any more cuts this year. Why? Because the fundamentals just don't support it. GDP surprised everybody to the upside. Shelter inflation is still hot. Wage growth is still sticky. Global inflation pressures haven't fully faded. If the Bank of Canada cuts aggressively, bond yields would simply rise, canceling out the impact. And here's the fifth and final force, the one that ties everything together. The bank is terrified of re-accelerating the housing market. Every time borrowing gets cheap in Canada, demand jumps instantly. Inventory disappears, bidding wars return, and prices surge. They know that if they make the wrong move now, they create a second affordability crisis, a crisis that they may not be able to control later. So the safest option, hold the line, keep rates stable, let the economy cool naturally, avoid triggering another surge. So when you put this all together, sticky housing inflation, record household debt, a fragile dollar, stubborn bond markets, and the risk of reheating the housing market, you start to see why the Bank of Canada is shifting its tone. So now that we've unpacked the why, the real question becomes, what does this mean for you? Homeowners renewing in 2025 or 2026. If you've got a renewal this year, this is probably the rate environment you're renewing into. Maybe you get a tiny cut, but the big drops people hope for are just simply not happening. So this is the year to review your amortization, explore non-bank lenders, restructure debt if needed, and start your renewal planning early. People who plan win. People who wait get squeezed. If you're buying, stable rates might be the best news possible because right now buyers have leverage, more listings, less competition, and they have negotiating power. If rates drop even slightly, that opportunity vanishes. For renters trying to buy, stable rates means less speculative pressure, but they also mean fewer new rentals. So this is the year to build your down payment, clean up your credit, understand your borrowing power, get pre-approved early. The people who prepare are the people who win. So here's where we land. The Bank of Canada is done cutting, not efficiently, but functionally. GDP surprised us all to the upside. Shelter inflation is too hot. Debt is too high, the dollar is too vulnerable, and housing is just simply too expensive. If you're waiting for cheaper money, just stop waiting. This is the market that we're in, but you can still win with the right strategy. If you want help mapping out your numbers, understanding your options, or planning your renewal, there's a link below in the description. I'm Justin Chausse from the Chausse Mortgage Group, and if you like this video, please like and subscribe so that we can continue to make more videos like this for people like you. Thanks for watching, and I'll see you in the next video.